And good morning, everyone. John Hutchinson with Traders Reserve. Welcome to Breakfast Club on June 30th, 2025. Along with me is Jeff Wood. We will be doing split activities today. I want to dive right in as we have a good deal to cover. We'll try to get you in and out in 30 minutes so the croissants don't get cold. Coffee, however, I can't do anything about. Let's start right away with the weekly income report. I'm going to do a dual look. One is a look at last week's trading results for Income Masters and Millionaires Trading Club. And then I'm also going to look at the first 6 months as we are at the end of the second quarter and at the half year point. So some good just details to share. Not waste a lot of time. Last week, a little busier than the previous week for both services combined. So this is both Income Masters and Millionaires Trading Club together. We had 7 trades closed. Net income on those trades, $1,498. Total capital across those 7 trades, $19,492 for a 7.7% return on capital for the week for those trades. On the detail side, Income Masters closed 6 of those 7 trades. The average time in trade was a short 7.5 days. $17,500 in capital, net income $1,203, and a return on capital for the week last week for Income Masters 6.9%. We had 7 new trades, Netflix, which we have been trading extensively throughout the year, and I'll be doing a special dive on Netflix here in the next week or so. TMO, which is Thermo Scientific something or other, which I can't remember off the top of my head, IonQ, Palantir, Micron, CrowdStrike, and United Airlines. Those were the 7 new trades put on last week. We also rolled a number of positions as we did the previous week in Southern Company, excuse me, Meta or Facebook, Costco, the Spiders, and Vertiv Industries, VRT. So a busy week across Income Masters, and look for probably a lower new trade volume this week. Still managing or rolling positions for the week, but as it's a holiday week and we will be offline on Thursday and Friday of this week, you should see the majority of your action taking place Tuesday and Wednesday. Anything that takes place on Thursday will be alert only, but we're giving the whole team sort of an extended holiday weekend this year, so we will not be broadcasting on Thursday. But we will be obviously observing the 4th of July holiday on Friday. And for the 6 months, Income Masters has made a total of 101 trades. Of those are open trades, open and closed trades. Of those closed trades, 99 wins, 2 losses, a win rate right now of 98%. And an overall average time in trade of 8.75 days. So given all of the volatility, that's a solid record. That means we're still on pace for somewhere in the range of 200 to 240 trades for the full year, as we do still have open positions or positions that we are managing. And as we look ahead to the next 6 months, it's simply a matter of maintaining some stability in the market and both being able to recover on a couple of positions or a few positions and keep that time in trade as short as possible. So that's the turnover of your capital, which helps to increase the overall income that you generate. And on a monthly basis, we started slowly in January, but you could see as we got into February through the month of June, we've been consistent. We had a really big March. But the key months here between February, April, May, and June, running right around an average of $2,500, $2,600 per month. We'll see how things transpire in the months ahead. But that's really what we're targeting. This is based on a $100,000 trading portfolio. So net income year to date of $18,227 is pretty much on par with the total income produced last year of $34,000 for the full year. So we're slightly ahead of that pace. But we've actually made fewer trades this year versus last year at this point in time. It's a difference of about a total of 20 trade difference. So we'll see what happens in the next 6 months, but certainly a very good first 6 months and plenty to do in the second half of the year. Turning to Millionaires Trading Club, for the week, we closed one trade. That was Jeff's Apple trade, which closed profitably. We were in that trade for 12 days, $1,900 in capital on that trade, a $295 income across 5 contracts, and a 15.2% return on capital for that trade in those 12 days. So that Apple trade closed out all of our June event trades, which we'll take a look at here in just a second. We did continue to manage the Berkshire B and the XOP trades, which date back to the May live event, which took place the 13th, 14th, 15th. I think that's right. We did both MTC and Income Madness back to back in May. So I think it was the 13th, 14th, and 15th in May. So those 2 trades remain the only trades open dating back to May. For those of you in the Millionaires Trading Club, a reminder that this is the last short week. Next week, beginning July 7th, we will move to the daily program at 11 a.m. Eastern Time, Monday through Friday. Dave has already sort of reviewed the schedule with you in the preview session he delivered last week on Wednesday. If you haven't had a chance to watch that, it is in the recording section, or it should be in the Millionaires Trading Club room. So you can go back and watch that and catch up on the details. One of the key things to remember, this is true for both Income Masters and Millionaires Trading Club. Although we're broadcasting and will be broadcasting on a daily basis, this gives you some flexibility in the sense that we're not necessarily, as we go through the next 6 months, we're not necessarily going to be placing trades every single day of the week. We have that option if market conditions are favorable and if it makes sense to do so. But our primary trading days will be in the middle of the week, in the Tuesday, Wednesday, Thursday. The beginning and ending of the week, the bookends are really intended to give you a look ahead and a look back at what we plan to do and what we accomplished for the week. So it's important to remember this isn't something that has to keep you at your desk all of the time, because you also know, or you'll see in time, that new trade alerts will be consistent in their time frames. Although closing trades can vary because that depends on good till cancels being executed, opening new trades will generally take place during these live session periods of either 11 a.m. to 11:30 for Millionaires Trading Club or 12:30 to 1 p.m. for Income Masters. So from a new trade perspective, you should be able to manage quite easily on most of the days. But the addition of these days of the week is to give more people who are either more active or want more background training, education along the process of the tradings that we're doing in either program, especially inside of Millionaires Trading Club with some of the more advanced tactics, not the super hard tactics, but simply more advanced than a basic spread, that it's available to you. So think of this as a trading DVR. It'll always be available for you. Everything is always recorded and will always be accessible here on the Traders Reserve live site. For the year on Millionaires Trading Club, a reminder that we are shifting from a once-a-month event to a daily program. So this comes at a good time for us, splitting at the middle of the year. So for the year in 2025, we've held 6 events for the Millionaires Trading Club, a total of 35 trades, 31 wins, 2 losses, 2 trades remain open. The win rate on those wins and losses, the 33 out of 35 trades, 94%. So very consistent with Income Masters, both programs running well above the 90% win rate. We had a pretty slow start to the year. In January and February, $113, $250, $255. You can see in April, May, and June, however, we picked up pretty consistently. This is more along the lines of what we want to achieve nearly on a weekly basis. It won't be exactly on a weekly basis, but these goals of the $1,000 to $1,500 per week, that's essentially what Dave is targeting, and Jeff are targeting, Dave and Jeff are targeting. And we did that between April, May, and June. We had 3 very good months. June was spectacular, 5 trades, $1,800. and all of those trades closing within 14 days of the event. So total income for the year, given the limited trading and trade volume, $6,408. That's on a smaller trading portfolio because we're averaging about 5 contracts per trade on limited margins. So overall, very pleased with the progress in the Millionaires Trading Club and looking forward to what we can do for you upcoming in the next month and 6 months. So for the year to date, for both services combined, 136 trades, 130 wins, 4 losses, 2 trades remain open, a combined win rate of 95.6%, net income $24,635. Quick preview to sort of, and Jeff would probably be able to take you through some of the thought processes here on what's transpiring in the market. Taking a look ahead at the third quarter, one of the primary reasons you are seeing the market back at all-time highs is Wall Street has better or firmer answers to many key questions which they did not have the answers to in the second quarter, largely centered around tariffs. Tariffs have not been as bad as were feared. Number one. Number two, the economic impact of tariffs has been, the expectation of that impact has been lessened. It's not, the biggest fear in April was stagflation. That has not occurred as of yet. And then it was recession. That has not occurred as of yet. So the tariff issue still remains. It is still, I don't want to call it volatile, but it's still unstable, but we're getting more stability out of it. The Fed rate cuts, we know that the Fed is expecting to cut at a minimum in September. More and more talk about a potential July rate cut. We will see if that happens. That would certainly be a dovish surprise when the Fed meets later in July. And if they do, in fact, cut rates in July, I would not be surprised to see the market move up another 3, 4, 5% from current levels. The budget bill working its way through Congress. Remember, at the beginning of the year, the expectation was the Trump tax cuts would be that would sort of fly through Congress, that it has been slowed down, created some issues for Congress, for Wall Street. But as we near the 4th of July deadline that Trump set to pass that bill, we will see if they get that done. But once that bill passes, that just meets expectations for Wall Street. That's one of the key things as we look at these questions is at the beginning of the year, Wall Street had specific expectations across these categories. And as we went through the late first and most of the second quarter, there were more questions around these issues than there were answers. And now we seem to be reaching a point where Wall Street has better answers and can take the next step in moving the markets higher. If you're like me or Jeff or Dave, no, we're surprised too that markets have recovered, rebounded as fast as they have. But at the same time, we're also not surprised because that has been a feature of the Wall Street, of the stock market for dating back to roughly the 2016 year. These rapid V-shaped recoveries have occurred frequently, almost multiple times every year. So the big wild card right now will be earnings and the debt ceiling. The wild card, excuse me. Hopefully, with the passage of the budget bill, Congress will fix the debt ceiling. The debt ceiling, I think, expires at the year. We reached the debt ceiling at the end of July, but I don't see that coming into play. Earnings, however, really the wild card. This is where we want to keep our focus, both in the July and October quarters, particularly around stocks that we're trading, around tech stocks, around AI-related stocks, and consumer-related stocks. So are earnings impacted by tariffs, by consumer behavior? And if not, then this market has room to run. And we'll take a look at that in next week's Breakfast Club, and we'll take a look at second half and 2026 valuations and what Wall Street, or how Wall Street is pricing stocks here at the end of June. And it is a little bit surprising. So hang on for next week's broadcast, and we'll share that detail with you then. as these key questions have been answered, I think that's moderating trade flow. In other words, we're not seeing these volatile spike lowers followed by spike higher. That's giving some stability, as Jeff pointed out last week with the VIX back well below what, 18 now. So not much in the way of extreme volatility affecting the markets. And briefly, some of the things that we are looking to bring to Income Masters and eventually probably to Millionaires Trading Club in some of our sessions, a Q&A, question answer period with members. This is where members would be able to send a question in advance, and then that would allow Dave to formulate either a presentation or a serious look inside of a stock, a trade, what have you, to help people have better foundations, better understandings, and more confidence in their trading. We'll also be doing more case studies. This is reviewing both good, bad, and ugly trades. So a way for you to learn from things that work and things that didn't work, and be able to apply that in your own trading. And then incorporating more of a research component. This is the process that Dave uses to find stocks. If you read Filthy Rich Dirt Poor last Friday, I believe it was, Jeff gave out a scan that he uses to find stocks. And you can grab that on tradersreserve.com. Jeff, you can remind me what the title of that story is. I don't have it at hand, given that I'm in my presentation, but as we said, we're trying to focus a little bit more on giving people tools for research, so that you have more ways to find stocks on your own when you have more time for trading. With that, I'm going to stop and turn this over to Jeff. Jeff, let's get underway with all of your look at the economy and trades and things that we can do. Give me just a second, and it should be yours.
All right. Good morning, everybody. How's everyone doing? Let me know. John, can you hear me okay?
Yep. I think we're the only two people here.
No. All right. Even so, not even if that was the case, it would not be a bad way to spend the Monday morning. All right.
I just spent many a Monday morning exactly that way, and
yeah, I know, right?
We had fun.
This is exactly this is kind of actually how this whole idea came about. Anyway, I only have a handful of slides to go over, so and then I'm going to go out to charts and kind of show you some different things depending on how much time we have. We'll go from there. All right. So economic calendar is really important, especially for those short duration trades. We want to get you set up for what might impact the market this week. Luckily, Mondays tend to be pretty slow, and that is the case. We do have the market holiday on Friday. So that is good. So typically on these holiday weeks, we see lighter volume. Now, the holiday weeks prior to the 4th of July, or at least the 10 days prior to the 4th of July, have been bullish. We certainly saw a bullish move in the market last week. So we'll see how that goes. And then the bullishness actually tends to continue after the holiday, or at least after the 4th of July. But we'll see if that continues, and I'll show you why. What I'm looking at and why that might not continue this year. Anyway, tomorrow we have the Fed Chair Jerome Powell speaking. You never know what he might say or how the market might react. So if you are day trading, or those who like those zero DTE trades, might want to look out for Powell talking tomorrow at 9:30. The other one that kind of caught my eye would be the JOLTS job opening. We do have forecast 7.32 million versus 7.39 million. So, I don't want to say shrinking economy necessarily, but it's just a shrinking amount of jobs, at least from the prior report. Not necessarily a bad thing. That actually might push the Fed one way or another. But what we are seeing is a forecast to see a slight uptick in the unemployment rate from 4.2 to 4.3%. The other thing that kind of caught my eye was the average hourly earnings going from 0.4% down to 0.3%. And why all this sort of caught my eye is that if unemployment is ticking higher, the average hourly earnings are not matching inflation. And those, and the average hourly earnings are going down, even if inflation stays the same at this 2% or so, and we have hourly earnings not matching 2% on a macro level. This is what John loves. This is what John specializes in. That could come into play months from now. I don't think it's going to really impact the markets this week. I don't think Thursday, just because average hourly earnings are tick down a little bit, I don't think we're going to have a market meltdown or anything. But on a macro level, that is something to start paying attention to. If hourly earnings can't match the pace of inflation, then we have some potential issues. And certainly as unemployment rate ticks up. But 4.2 to 4.3%, all very normal, especially with all of the unknowns that John talked about earlier with tariffs and everything else. There was certainly big fear of tariffs. A lot of the tariffs kind of peeled back. We'll see what happens July 9th. That could all change, but that's the tariff deadline. But as of right now, I'm seeing a pretty light week. There's a lot of reports, but it should be fairly light and in light volumes trading this week. All right. This is the sector rotation last week. For those who were here last week, one of the things I said was if you look at the 20-day moving average column and you look at those that column, when it gets above 90% or certainly below about 20%, those are the areas that you want to start looking at. Above 90% tends to be a overbought area. Below 20% tends to be an oversold area. So energy was 96%. Now, if you remember last week, we just had the whole bombing of Iran. Everyone said, oh my gosh, get into oil. This is going to skyrocket. Energy, energy, energy. Had a lot of talking heads talking about how energy was going to go up. Now, that doesn't necessarily mean that certain stocks within the sector can't continue. But overall, what I said last week, last Monday on this very time, was that energy was a sector that seemed to be a little bit overdone, in my opinion. And if we move ahead, this is what happened after the last 5 days. So energy went from 90-some% down to 52% of stocks now trading above their 20-day moving average. So that means, which I'll get into the performance part, but that means quite a number of energy stocks fell through their 20-day moving average from last week. What does that mean this week? Well, information technology getting a little frothy up at that 86% level there. And certainly communication services being at 91%, I would look to be a little bit cautious on communication services and information technology. Now, the issue with that is that's a lot of the tech-heavy stocks. Tech-heavy stocks are the ones that tend to move the market the most. So when those two sectors are a little overdone, doesn't mean that they can't continue to grow. Stocks can stay above their 20-day moving average for quite amount of time. But overall, those sectors are looking a little hot to me. So if you're going to find stocks within those sectors, that's okay. That can still run. You just have to be very particular about the stocks that you find in those. We already have a lot that are there, and big hedge funds, Wall Street, whatever. There's it's the whole Seeking Alpha. That's the name of that publication. They're seeking where they can get the most bang for their buck. Where are they going to get the next move? Well, communication services, information technology doesn't mean that they can't continue to grow, at least for the next week or 2 weeks or whatever. But that move is probably already done, at least for the last week or two on that one. So they might start looking at some of these other sectors to see where we could rotate into and get a little bit more return in the coming weeks. Anyway, so energy, which we talked about last week, is staying away from energy. And that was over the last 5 days, that was the biggest loser. So hopefully you heeded my warning and stayed out of energy, or if you stayed in energy, hopefully you found those 1 or 2 stocks that were moving higher in energy.
Or you went short.
Or you went short. Yeah, I mean, exactly right. That would have been good too. So communication services, now again, going back to the sector rotation, communication services is down here at that 91%. Prior week, it was at 57%. So definitely a big move from one week to another. And that explains, or, it's all sort of telling the story. Communication services went up by 6.2% just in the last 5 days. But again, I would just be a little bit cautious there. Now, if you're looking at stocks that are beating the S&P 500, which is what I like to do, is stay in strong sectors. If you look at the S&P 500 return over the last 3 months, it's 8.43% over the last 3 months. And so consumer discretionary is matching that. Communication services, although I did say be a little bit cautious about that. Industrials, and information technology, which again might want to be a little bit cautious on that. So those are kind of the 3 sectors, or a handful of sectors that are beating the S&P 500, and you want to make sure that you're staying in those strong sectors, but you just need to time that a little bit. So I'm going to go into our live charts. We're going to take a look at what the market is giving us. So just bear with me 1 second as I find my Zoom controls. And now we have to find Thinkorswim. Let's see. Hopefully there is Thinkorswim. All right. Good morning, Sorcerer. Okay, so here is SPX on a weekly chart. So it looks like pre-market, NASDAQ up 0.5%, S&P up 0.3, and Dow up nearly 0.5%. So that we'll see if that holds into the open. Sometimes pre-market, reverses at the open. Sometimes it continues. So, but very interesting pre-market stuff. So really, again, investors, everyone's ignoring anything with Middle East, anything about Iran sending out messages and whatever else. All that seems to just not matter to investors right now. But yeah, John, what were you?
Are these your Heineken, Asahi?
Yeah. I'm going to get to
beer
that.
Candles.
Yes, I'm going to get to that in a second. Yes, I wish they were Heineken candles. That would be good right now. And VIX, as John mentioned, 17.14. This is a whole whopping 17%. So really, with everything going on in the Middle East, investors don't seem to be too worried, as the VIX is stuck. Sub 20 level. All right, so this is Heikin Ashi candles. This is a weekly candle. Heikin Ashi candles help smooth out the trend. I'll show you the difference. So just kind of imprint that in your mind. We'll go to a normal. Whoops, that's not the one I wanted to do. Let's go to our candle. So Heikin Ashi tends to smooth out gaps and everything else. It's fairly easy to still read this way, but just for the sake of argument, we're going to go to Heikin Ashi bar. And this is going back to really 2022 and beyond. So obviously we had a nice 23. But what I wanted to kind of do just really quickly is do some Fibonacci extensions to see where the market might be moving. So if we go to our Heikin Ashi low to Heikin Ashi high, there's 3 points. And so you're basically doing this at every swing level. So that was a swing low, swing high, swing low. I promise this isn't going to take too long. Swing high to swing low. Roughly, I'm not perfect at drawing these here, but we'll. And so when you're doing this at the swing highs and swing lows using your Fibonacci extension tool, let's see, there was a high over here. I mean, you can almost take it by the every time the candles go from red to green, which is really why I was kind of showing the Heikin Ashi candles. But what you're looking for is areas of confluence, areas where multiple Fibonacci extension lines kind of line up. So this is a 261.8% extension line, matches up with another swing at 100%. So what we're going to then do is take our rectangle tool and start drawing out. I said we're going to start drawing out. There we go. These areas where multiple lines sort of come together. So here is one where almost the multiple lines are on top of one another. And then we really don't have anything for a while. We can always flag this one just as a even though there's not multiple lines, but this is one of the lines that are above the market. And then we can start clearing up our charts by getting rid of all of these drawings. And come on. All right, that wasn't so long. So then we can go back to our normal candle, and then we can go to, let's say, a daily. And so we're kind of in this gray area, which this gray area was an area of interest based on Fibonacci extensions. And that makes sense because we were kind of touching this area once, twice, and now 3 times. So if we can break through this gray area, then our next real area of potential resistance is up at 6,300. We're at 6,187. So there's still quite a bit of room for this market to go. And then really 64, 66-ish. And again, these aren't exact numbers. These are just zones of interest. But those would be the next sort of 3 areas. Now, given that seasonality, which is another chart we can go look at, which is chart mode seasonality. And now remember, in seasonality, you need to load up how much time you want to look at. So this is only loading up 5 years. So let's say that we want to load up the last 10 years of data. And this may be a little difficult to see, but if you notice, I mean, this isn't really too much of a bottoming out necessarily, but right around July 1st, and here I can draw a line. So right around, there in the past 10 years, there was a little bit of weakness the week from 626 to 71. So we didn't really have that this week. The last week, the market went up instead of down. But now we're, today is 6:30. And so what typically happens in July is we have this run up higher, about 4-ish% or so through the end of July. So July is actually quite a bullish month seasonally speaking. But the question is, did we already have that move in June? And, could we have a pullback? We never really had that weak pullback from 626 to 630. So, might we have that this week? We are running into an area of potential resistance. So we might slow down for a week or so, but I certainly see that we can make it up to this, this area around 6,300 and then beyond that. So now let's go to a non-seasonal chart, and I'll just show you something else. Let's see, what was it? I just lost what I was going to show you. Anyway, so that's kind of where I see the SPX. Now, if you're thinking that, so one of the things that gives me a little bit of pause about so much of a bullish July is that we've already had this incredible move from April through June, really without that much of a pullback. I mean, the only pullback we really had was like this little bit here and this little bit here. So it wouldn't surprise me if there was a slight pullback before, we go try to challenge new highs, or, continue on with the new highs, or try to get up into one of these zones. And then if you are saying, yeah, I think there might be a pullback here, what we can always do is our Fibonacci resistance area. And depending on kind of where you see, I mean, this impulse move really started here and has moved all the way up here. Now, I don't think we're going to get all the way down to 58.67. And the reason why is if we take our line chart here, let's say we broke down and something happened next week, that's a 5% correction. I don't think we're going to have that, one, because that would also take out the previous swing low. So that just doesn't seem as likely to me. So maybe, on an overall, an important level that you might want to watch for support. But what I'm thinking more is it's kind of this move to this move. And so if anything, the areas of support that I'd be looking for this week, it would be around 60.86, and then going down to 60.20, and then 59.76. Again, I think it would take a lot to break through 6,000. So if anything, if you're looking for sort of a pullback of any sorts before you get into the market again, I would try to see if the market can get down to this 60.88-ish level, or even maybe 60.21. But with a short week, holiday week, that would be a little surprising to see that much of a pullback unless something happens news-wise.
Well,
And
we
really,
need to put let's see, that times
and if,
66.37. That's our next top target.
whoops, yep,
Should
and
be at the top, that big gray bar you have way up there by itself at the top of the chart.
yep,
What's the top end of that gray bar? Probably around 65.
yeah, yep, 65.
Yeah, I can make a case for 65.25 and 66.37. We can do that next week.
Yep. So if it does go down to this 60.24-ish level this week, I mean, that would be a 2% pullback. I just don't see that happening on a holiday week. But certainly, yeah, I mean, we could get down to this 60.86-ish level. And again, that's more of a pullback just to see if we can get in. Well, but the market, again, pre-market is already heading up another 0.5%. So we'll kind of just see where that goes. When the market goes up 0.5% at open, if that holds true, that's a little bit, for me, a little bit cautious. I don't want to necessarily get in after the market has already sort of made its move, but we'll just kind of see how the day goes out and how the week plays out. But again, we already talked about VIX. So if there's anything else, any other tickers that anyone wants to look at, I'm happy to do so right now. Otherwise, I think we're gonna call this a morning.
And then starting the week of July 7th, we're also going to try to begin adding days of the week, correct, Jeff?
Yes, probably Monday, Wednesday, I think.
Yep. So we'll start expanding Breakfast Club right after the July 4th holiday. And so you get a little bit more insight on a daily basis. We'll keep it closer to the 30-minute mark as we are able to do more days during the week. So with that being said, we'll have the recording up here in 10 to 15 minutes.